Welcome to this week's Midweek Market Update. My name's Andrew Wilkinson. I'm joined by Interactive Brokers Chief Market Strategist Steve Sosnick, and our special guest today is Barron's columnist Steve Sears. Welcome to you both, gentlemen.
Great to see you, Andrew, and always a pleasure, Steve.
Thank you, Steve. Same.
So I've been involved in financial markets for 35 years now, and this has to be one of the wackiest I've ever seen. The US government has now officially shut down. We're recording this on Wednesday. When that carries potentially severe implications for government workers. There are out-and-out wars in Ukraine and Gaza, and an increasing sense that we are no longer at peace with Russia. The US Secretary of War, no less, yesterday gathered top military officials at Quantico. So, Steve Sears, you've written about investors climbing a wall of worry before. That concept must be resonating in your head these days, isn't it?
It is, and I'm amazed that the wall continues to grow and equities continue to advance. Options volatility remains subdued, and even within the treasury markets, yields are quite reasonable, and even funding spreads on those yields in the various fixed income markets are operating in completely normal parameters. I think that we're truly in unusual times. I'm not going to say this time is different, but I think the one thing that I keep coming back to in my mind that I find to be very intriguing is that I think for the first time, perhaps in history, we have a very educated, very sophisticated retail investor operating in ways that we have never seen before in history, because as individual investors really only entered our markets around 75, and it's really since the mid-90s. And I'm stunned by all the things that they discount and by their collective impact on equities. And one of the most interesting things that I've seen is how at some of the major sell-side banks, particularly in the derivatives strategy desks, they're treating individual investors as if they were equal to hedge fund investors who tend to be more sophisticated institutions, at least superficially. So it's truly unprecedented times, just as the risks that you enunciated are unprecedented.
Steve Sosnick, what do you make of it?
I think if I'm going to term this market regarding Steve's wall of worry comment, this is the Spider-Man market. Basically, this market just scampers up the wall of worry, and any little crags that are in its way, any little outcrops, are essentially ignored. As we're taping this morning, October 1st, we saw futures lower overnight, which has actually become typical, by the way. 6 of the prior 9 first trading days of the month this year have been lower. We were looking at number 7 by the time we're taping this. We're basically back to unchanged because there's a few truisms that I'm seeing in the market. Truism I'm using, truism with quotes. Number 1 is all news is good news. The government shutdown, inconvenient. And hey, it's good news because if it leads to a weaker economy, that leads to more rate cuts. And so good. This morning, we got weak ADP numbers. Again, in theory, a lousy economy should be bad for stocks. But if you can do a little mental jujitsu and say that, again, that leads to lower rates and the better prospect of rate cuts, well, then let's rally. You can basically do this with anything. At this point, the market has become very adept at fitting the desired outcome to the narrative, rather than the other way around. And I think that, to me, is the biggest fundamental change in markets that I've been seeing recently.
There's something that I find fascinating is that the minute that the ADP report came out, the ticker was filled with headlines saying 100% chance that the Fed will cut rates. And I remember when I started my career, that we didn't have this type of a feedback loop, if you will. And I think that's amazing. It's anything that's bad is good and good is really good. That said, when we spoke last, we discussed what our outlooks were and where we'd want to be invested. And I said equities. They'll say equities. And despite if you were to strip everything back and do that sort of reductive analysis, earnings thus far are growing. And as long as earnings are growing, you're going to see stock prices continue to rise. In my view, there's always the risk of it. There's always an exogenous risk, like we get a fully hot war that spreads in Eastern Europe. But frankly, I'm not even sure if that would be fully negative for more than a couple of days or a week before it gets priced in.
Markets have become very adept at ignoring geopolitics. And to be fair, to a large extent, they should, because ultimately, most geopolitical events don't affect the things that affect stock prices. That's the stock fundamentals, I should say. Earnings, revenues, cash flows. Honestly, if the government shuts, this was the facetious argument I made to somebody, but it wasn't really facetious. If the government shuts down, what does that do to NVIDIA and Microsoft, Google?
Nothing.
No. So let's ignore it and let's ride them higher is the mentality. If it's not, whatever doesn't kill you in this market makes you stronger. And in this case, a lot stronger. And since this market's eaten a lot of potential poison over the past 3 years, it takes a lot to kill it.
You know what, though, Steve? Like a couple of years ago, there was a documentary that came out, and it was a fellow from Hong Kong who had been raised in Boston, and his father had literally escaped Hong Kong right before during some of the more difficult times in China. And the father basically swam for mainland China, went to Macau, made his way out, comes to Boston, and sets up a Chinese restaurant, raises his kids. The kids go off to attend university. And then many years later, the son takes the father back. But all the relatives are living in Hong Kong. And there was a line in this that I think of quite a bit as we look at the markets. And they were talking about inflation and how dynamic the Chinese economy had become. And they all said that in order to keep pace with the cost of living, we had to be investors. And I think that a lot of people feel that they have to be investors and that this has some type of upward impact on stocks. And I'd be curious to hear what you think about that and what amongst the clientele you guys service.
Our clients are relentlessly buying stocks. And any given week, I don't have great clarity into what they're doing, but I can see on a daily basis the 25 most active names on our platform. On any given week, that number ranges from 25 of 25 to, in a bad week, it's 20 of 25 or 21 of 25. Because again, if we go up, let's chase the rally. There's momentum to be had. If it goes down, there's a dip to be bought. Let's buy it. So we really, and some of the biggest numbers, to our customers' credit, some of the most biased numbers toward the buy side were in April. So I will say it's worked for them. Buying the dip has essentially worked relatively unimpeded for the better part of, I don't know, pick your number of years. And so if something keeps working for somebody, for a large group of people, they're going to do it. Yeah. Now, perspective here is, I saw a stat this morning. I wish I could cite it. I forget exactly where I saw it, was that somebody estimated that only 4% of portfolio managers were professionally investing during the late 90s, and I'd also imagine that number of active investors, particularly the most active investors, most active traders, that figure is probably about right. So that goes back to the tendency of history. History doesn't repeat, but it often rhymes. And I've been seeing rhyming elements to the internet bubble. Again, not repeating because there's a lot of constructive differences as well. But when I start to do the numbers about how much money is required to build out these data centers, it's got to come from somewhere. And effectively, I think back to the example of Global Crossing or Northern Telecom, which were among the companies wiring the world. And it worked by all means. It was something that needed to be done, but no one made any money from it. And I start to wonder that, do the math on Oracle. I put this in one of my columns. Do the math on Oracle. If they've got a $300 billion data center deal with OpenAI, sounds fabulous. That's phenomenal. They got to spend a lot of money to build the data centers, and they already borrowed $18 million to do it. We're at $1 billion deal.
Billion.
Here, billion, sorry. Here's the problem. OpenAI, the last annualized revenue numbers that I saw from them were $12 billion a year in revenues. And their cash burn was $8 billion. So how are they going to get enough revenue to fulfill the deal with Oracle, and at what price, and who? So that's where I start to see these parallels. And I will say that a lot of these deals are, I may have used the term incestuous, but that's probably a bit strong, but there's certainly a lot of circularity to them.
I don't see by any stretch.
I'm sorry, Steve.
I don't see them as being as an arm's length transaction. But that's Steve. Like, the thing that fascinates me is I was reading non-financial publications. There was some new large language learning model that was essentially able to do things in terms of computing power and synthesizing information and producing workable results that was hitherto considered to be an impossibility. I remember, I guess, as a little boy, I always wanted to be able to walk through the library and touch the spines of books and then know what was in them. And of course, it's eluded me. But it seems to me that this AI, at its best application, can do just that. And if you speak to your friends in the medical profession, they talk about the ability to diagnose and to discover new treatments and to come up with new prescription solutions that defies human comprehension. And I often think it's a lot like maybe in your days when you were on the desk and your desk was so sophisticated at using computer power to price. And I think that we're there. And so is it a bubble up? Is it a bubble down? I don't know. It certainly seems to be elements of frothiness. But that said, if we're going to ride it up, you want to be long calls and short puts. And if things going to talk, you want to be like long puts and short calls. And I think it's just a trade. And when the internet was being built out, a colleague of mine met with Larry Ellison, and we were all,
there's that name again,
right? Then like now we were trying to figure out exactly what was going on. And there were all these sorts of conversations. And my colleague came back and he said that it never made it. I don't think he published this, but he said that Ellison told him that his vision or his dream was to have basically one of his servers, at least one of his servers, like in everyone's house, in every company. And I think that's largely happened.
Well, that's clearly what he's going for now, not necessarily in everybody's house, but with massive data centers. The vision is still the same. And I will stipulate that everything the internet promised came true. Just didn't work out financially in the initial way that people had expected or hoped. That's where the disconnect, I think, starts to come in. Ultimately, if all these billions of dollars are going to be spent, right now, companies are being rewarded simply for spending the dollars. And to a large extent, many of these companies can. I mean, Meta, Microsoft, et cetera, these things are cash flow machines. I think, though, what you're starting to aim for, though, they have it.
That's right.
But you do have to wonder if this paradigm, by the way, is like the Netscape, is ChatGPT the Netscape browser of the AI era? And I still venture to say that the best AI model is probably one that either hasn't been written or is being written by a high school or college kid somewhere. And I used to just say in Silicon Valley, but that could be literally anywhere now. And I do start to wonder whether the better AI models aren't more focused rather than trying to just be masters of everything. I think the better models probably I would think if I was a doctor, I'd rather have AI models that are really very specifically trained on medical data.
And they exist. And the guys are telling me they have AI. I think Microsoft is very big in this, where they would otherwise have to spend hours each day transcribing or have a stenographer follow them in, that the AI enables them to do it like that, freeing them up to see more patients. But one of my friends his family business made millions
doing transcription of medical data.
Right?
They sold the company, and my friend is very wealthy as a result. But yes.
Steve Sears, we had FANG, then we had the Magnificent Seven, and both of those lost their luster with AI names picking up the leadership. What companies are you seeing that are taking up the front running?
Oh, it'll still be the Magnificent Seven, as they say. You look at your top 25 at Interactive Brokers, and I think that's a pretty decent representation of what's hot. If you look at the environment in which we operate in, what's hot gets hotter, what's cold gets colder. Still, we see something happen. If you go back to the influence of the news cycle and this 24/7 jackhammer of information. Last week, things were very bad and things were going to go down. This week, things aren't so bad. And you can choose your name and swap it out week by week. But I think that you're going to continue to see these trends. You're going to continue to see the Mag 7. Take a look at Meta. A couple of weeks ago, Meta was trading under the cloud of what the street politely termed as obscene spending on data centers, right? And you've seen the stock winnow down. It's down 20 points today purportedly on news that they're going to create their own chip as opposed to just buy it from NVIDIA. I'd be willing to bet anybody sooner or later that stock's going to catch a bullish wind and rally. Why? Because someone's going to come out and say at a sell side bank, I think that it's fairly valued, or people are not looking closely enough at all the merits such as X, Y, and Z, and that thing will rise 50 points in a week. And then it'll rise up. Look at Tesla. Tesla's another great example. Tesla's in the gutter. Tesla's basically now almost at its all-time high. And you could just swap out everything I said about Meta, tweak it a little bit to make it specific to Tesla. And there we are. We're in an innovation era, and amazing things are happening all around us. The only question we have now is one of price. And the big guys are going to push it up. The big guys are going to push it down. Retail is going to glom onto it and make some money. Although I think they don't make nearly as much money as they think they're going to make, but they're making money. And as Steve referenced earlier, they're going to keep on doing it. And I think we're going to see these big tech names. You're going to see anything that can benefit from the allure of AI. If we changed our names to AI Steve, something great would happen.
That was a big deal. That was a big deal in 1999 where companies would do that.
So I was there and I covered Amazon IPO at $14.
Mm-hmm.
I remember Pets.com. I remember all of the big hot names. And I remember when Amazon was coming public, the street was very negative on it. And there was a lot of talk when the thing was still being syndicated on the street that it was nothing. And of course, he's now, I think he's one of the richest or one of the richest, and everybody buys their crap off of Amazon. I think we're just in a transition. And to get back to the point earlier, Andrew, about the wall of worry, I would put forth that when we're having conversations like this, and there's thousands of other people having this conversation, it creates an exquisite tension that offsets most of the concerns, not all, but most. Mm-hmm. Because whatever takes us down, we never really see. We didn't see it in 07, 08. We saw it in 99 because of Barron's talked about all these companies burning cash flows. But I think the more we talk about it, the less risky it becomes, which doesn't mean that it's not risky, because it's always risky, but it enables those of us who know how to define risk to better define it.
To quote Oscar Wilde, the only thing worse than being talked about is not being talked about. But I do.
Oscar Wilde also said a burnt child loves the fire.
Both can be true when it comes to this market, can't they? Yeah. By the way, I've been trying to make Gamaton a thing, adding Oracle and Oracle to the Mag 7 lingo. Somebody then pointed out that I left out Broadcom. I need a B somewhere, but we could double another one of the A's because its symbol is AVGO. So
I will join that extremely worthy effort.
Okay.
And we'll figure that one out. The final question for Steve Sosnick. You mentioned the ADP report on today, loss of jobs for the economy. What's your prediction for Friday, Steve?
Nothing. We're not going to get one.
No way.
That's my
What's going on?
prediction.
Powers to
There
be.
have been conflicting reports. In theory, I do believe actually the report is done. So I think they could report it because I don't, you'll need a better source than this, but I read somewhere that they actually do it on Tuesday, pre-release it to the people who need to know on Wednesday, et cetera, et cetera. But there have been enough comments saying that it's not coming. So my prediction is not coming. And somehow the thing that I will say here is that this is another one of these careful what you wish for things, where you have, if the Fed is truly data dependent and you don't have jobs report on Friday and you don't have BLS releasing PPI and CPI next week, we did get the core PCE number, which was okay, annualizing to a number that should be well above the Fed's target. But again, we've been getting that for months and it hasn't really mattered to anybody anyway. But I do think that has to put a little bit of reticence into the Fed if you're going to claim data dependency and you don't have data. So let's see what happens.
Where's the backup generator? You need a Generac or something.
It's not the Generac, it's the people showing up to do it. If I'm not getting paid, I'm not coming in either.
We have all this data produced by the private sector, which is probably the higher quality. It is in the lingua franca of the investor class. I think they can probably figure it out.
We got the private data today, and it's not particularly pleasant. But again, does the Fed, if they're going to be data dependent, you're right. But to some extent, you can't fully replicate the government data with the private sector.
What it references, all data is created equal, but some data is more than others.
There we go.
I'm Steve Sears. I write the striking price column for Barron's.
Right. And I'm Steve Sosnick. I'm the chief strategist at Interactive Brokers. And it's been a pleasure chatting with you, Andrew.
Thank you, everybody. Don't forget, subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.